Okay, so we are the healthcare sector. My name is Frederick Bergener, and I'm a senior analyst.
John Carrillo, senior analyst as well.
And I'm Majid Abdul, I'm a junior analyst.
So for our presentation, we're going to divide it in 3 sections. Majid will give an overview of the current state of the healthcare industry. I will cover details of our model, and then John will provide the assumptions and our rationale behind the recommendations that we are making. So, Majid?
So good morning, good afternoon. Just an overview of the industry. It's been a really good friend with the U.S. economy. Thanks to its plentiful jobs added, it helped lift the economy from the recession in 2007. And primarily due to the Affordable Care Act, it now employs 1 out of 9 Americans, up from 1 out of 12 in 2000. The country has grown increasingly dependent on the healthcare sector to provide the economy. Also, 35% of the nation's job growth has come from the healthcare sector. It's the single best or single biggest sector for job creation in the U.S.
Over what period?
Since the recession,
Since 2008?
since 2008.
Sorry.
The U.S. consumer health industry is expected to remain a strong center for investments, development, and innovation or technological innovations. The election of new President Mr. Donald Trump did create some uncertainty along the industry, governmental agencies, and consumers, especially around the regulations, local production levels, and changes to the Affordable Care Act. In his meeting in January, actually, with former leaders, he demanded that the industry increases the local production in the U.S. levels and lower the prices while promising to keep or speed up the upgrade period for new medicine. But the issue with increasing local production is that it inevitably increases the production costs. With low prices, this could affect the profits in the industry. But however, all in all, we do expect that to remain a healthy sector despite this uncertainty and specifically due to the demand inelasticity. Now, a quick summary of the model. Instead of making one ranking model, we did 5, one for each industry, sub-industry, pharmaceuticals, biotech equipment and suppliers, healthcare providers, provider services, and healthcare technology. We employed sub-industry specific metrics that are of paramount importance. These specific metrics allow us to properly value each company relative to the respective peer set. This is in stark contrast to creating a consolidated model that generalizes the many different facets of this complex industry. I'm going to pass it on to Freddie to give you more detailed information on the model.
Okay, so for our models, what we did was we built a ranking model. We initially started off with a regression using profitability and risk metrics to forecast a relative value metric. For profitability, we focused on things like revenue growth, margins, and then as far as specific to sectors and industries, so for example, pharmaceuticals, we looked at research and development. For risk, we wanted to look at default risk, and then also price volatility. We felt that those were 2 very important things to look at, and then we just picked one relative value metric for each industry. Question?
How many companies did you evaluate, and what was your starting set?
So let's see, for the whole
universe for healthcare.
whole healthcare sector, or for?
Oh, okay, so it's all the companies that are considered healthcare, irrespective of market cap, for example?
Yes. So we started off with the Russell 3000 index and took all the healthcare companies from the index and then separated by sub-industry. And then we had to eliminate a few companies because of size, so real micro-cap companies that we don't really have enough information on, and companies that just we couldn't get data on. So as far as our model, this is basically what it looked like. Here, so we have our profitability metrics, we have our risk metrics. So to make things a little bit more broad, I guess, or more thorough, we took 5-year averages of some of our profitability metrics as well as our risk. So we would take 5-year average of, say, WACC EVA spread or EBITDA margin. And then another thing we did for risk is we took the standard deviation of both EBITDA margin and gross margin over 5 years, because we don't want a lot of volatility in the margins for the companies. So we use these, so we ranked them by these metrics, and we use Solver to optimize an R-squared when sort of, I guess you could say, we ran a linear program comparing the growth and risk metrics to the relative value, which in this case, the pharmaceutical, we use price to sales, and then we ranked them by our value, our intrinsic value, and then by what the market value, and we would look for the largest difference between the two to find opportunity for growth or for investing. So we did that for 5 different sub-industries. And here's a summary of the 5 models that we have with the metrics that we used and then the R-squareds that we got. So for one, biotechnology, we decided to completely ignore the industry because we had a really hard time getting a significant R-squared, and we believe that the industry is a little too complex for us to really make some solid assumptions. So for our recommendations, we strictly focus on pharmaceuticals, healthcare providers, and equipment suppliers, and then healthcare technology. And then another thing that we took into account with our recommendations, so we focused on the profitability, the risk, the relative valuation, and then the last thing that we focused on was momentum. So we created a technical analysis little model to give us an idea of what's going on. So basically what we want is a company whose stock price is currently above the 50-day moving average. We believe that this is a strong sign of momentum, and that the moving average can act as a support level for the company as the price goes up. So for our final recommendations, I'm going to hand it over to John.
Alrighty, so first of all, I'm going to start off with our current allocations, so what our portfolio already has. They're highlighted in yellow. Boston Scientific, Cross Country, DaVita, Heska, Johnson & Johnson, Merck, Nuvasiv, Zoetis, and Cerner. So Boston Scientific and Cerner were added in November with our most recent pick, year-to-date 21.96% and 36.69%. Then I'm going to move towards the companies we want to sell. So first of all, we wanted to sell Cross Country Healthcare. We wanted to sell DaVita, and basically those 2 sales, as you can see for Cross Country, they haven't been doing well in the last, and from year to date. And DaVita, although it has a good year-to-date performance, their actual metrics and their fundamental analysis has faltered. We believe they're already priced into the market, defeating the purpose of having an undervalue in this relative model. So those are the reasons why we sold those companies. Now the companies we see to buy, so Mallinckrodt, their year-to-date performance is negative. It's negative 5.82. It's below the moving average but approaching. And we also feel that they have strong momentum moving forward. We feel that they're going to reach their actual intended price, the intrinsic stock price. And also, in lieu of using a DCF model, we went ahead and used an analyst recommendation. So due to the complexity of this whole industry and the amount of time it would take to actually do a DCF for each and every single company, valuing them correctly and not just making a generalized assumption about the whole thing, we went ahead and did analyst recommendations. So as you can see, Mallinckrodt overwhelmingly buy, and Medtronic, they also have a buy with a strong hold base. And then let me see, sell. So we have sell here, and then hold. Okay. So hold, we have Boston Scientific, which was bought in November. We feel that they're still going to be doing great, and we feel their fundamentals have not faltered, as well as Heska, Johnson & Johnson, and Merck. So we feel that this model here, we made some strong picks in the midst of a lackluster healthcare industry that we've had over the couple months, with a lot of lack of confidence in the market, with Donald Trump being elected and whatnot. Everything's a bit in limbo, but we do believe things going forward are going to be great and profitable with the companies that we've selected. So I would like to end this here. Thank you very much, but I would like to open it up for questions.